Good morning, dear learners, and welcome to you all to the next lecture of my course on financial literacy. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you all to the 6th module, Investment in Security Market, and today we will be going to discuss about the various essentialities and different aspects of investments in money market. So, this is lecture number 27. Welcome to you all. In the previous lecture, we have discussed the investment procedure as well as the different aspects of security market, where we had discussed for the purpose of investing into the long term security what different kind of procedure you need to adopt and what are the different investment avenues in the capital market. In this lecture, we will be going to discuss if you need to invest your fund into short term financial investment avenues, then what different kinds of investments you may have, as well as we will be also going to learn that how we should invest into the money market securities. So, in this lecture we will be going to cover at first the overview of the money market, how the Indian money market is framed, as well as we will be also going to understand the various key features, that is the specifications of the money market, and we will be also going to understand what different kind of financial securities, that is the financial instruments, are available in the money market, and we will be going to learn how one individual can invest into the money market schemes, as well as we will be going to discuss the real world scenarios of investment into the money market, and at last we will be going to discuss the significance of the financial market in the economy. What is the contribution of this capital market and money market in the economic growth of the country? So, let us start this particular lecture. So, first we will be going to understand what do we mean by the term money market. So, in the previous lecture, as we had discussed, that for the purpose of procuring long term fund, the corporates can take the help of securities market, that is the capital market, where they can raise funds with the help of announcing IPOs, FPOs, as well as they can also have some other issuance methods with the help of which long term funds requirement of the corporates can be met. Now, suppose that if there is an organization or there is a banking company or there is a public sector unit whose short term financial needs are there to be fulfilled, what different things they can do for the purpose of raising the short term funds from the market. So, for that they have money market. Money market is a specialized market that deals into the short term financial instrument. That means here you can invest your money for a shorter period of time, stable and regular returns will be there, as well as the liquidity of funds will also be maintained in case of the money market. So, this is a marketplace from where the corporates, the banking companies, government organization and individuals can very easily procure short term financial resources, as well as the investors who do not want to invest their funds for a longer period of time, they can invest into these market and they can maintain the liquidity of their fund. So, here we can see that it is a marketplace where banks, financial institutions, corporations, government, all these different type of institutions trade in short term financial instruments such as the treasury bills, commercial papers, certificates of deposits to manage their immediate cash needs. That means that these different financial instruments are available into the money market, where you can invest your money for a shorter period of time, as well as you can also have some assured returns. So, obviously, if your financial objectives are short term in nature and you want to have some stable and regular return by maintaining the liquidity of your fund, you can invest into the money market. So, the components of the financial market, as we had discussed, are the capital market and the money market, and financial instrument with high liquidity and short maturities are traded into the money market. This is a mechanism that leads with the lending of short-term funds only. The period of investment in the short-term funds in case of the money market may be 1 year or less than 1 year. So now let us discuss the various key features of the money market. So if we talk about the key features or the specification, so basically in case of money market, if on the basis of maturity period we categorize the money market of the financial system, then it is a kind of market where the maturity of all the financial instruments is less than 1 year, or it may be 1 year also. So here the maturity period of the treasury bills or certificate of deposit of various financial instrument that we are talking of may be 91 days or 187 days, or a maximum of 1 year of the maturity period will be allowed in case of the financial instrument of the money market. So the very important feature is that the time period for maturity of your investment in case of the money market is less than 1 year. The next feature of the money market is the type of financial instrument in which it deals. So basically money market deals into the different kind of certificates of deposits, commercial papers or treasury bills or call money market. These are the various instruments that are traded in the money market for raising and meeting the short-term financial needs of the corporates, governments and the other financial institution. The various participant in case of the money market are banks, corporations, RBI. RBI is, you can say, the regulatory body that provides the code of conduct or regulation with the help of which the various operational and management issues are handled in the money market. As well as there may be mutual fund organization and financial institutions. So these are the different participants in case of the money market who may participate into the money market, and they deal into the various types of financial instrument. So if we talk about the next feature of the money market, so the risk factor may be the next basis on the basis of which we can categorize the money market from the other segments of the financial market. So if we talk about the risk factor, it is very low as compared to the capital market, because here the maturity period of the financial instruments are less as compared to the capital market. As we had discussed in the previous lecture, that in case of the capital market, the securities are raised for the purpose of arranging the finances for a long term period. That means the maturity there can be more than 5 years, 20 years and so on, and in such cases it may be possible that due to the various economic and other kind of factors, the investment may be riskier for the individual. Whereas in case of the money market, where the maturity period is very less, the risk is also less as compared to the other segments of the financial market. Now, if we talk about the return, how much the difference is there between the capital market and money market on the basis of the return. So, obviously, since you invest your money for a shorter period of time and it also maintains the liquidity of your fund, the returns are lower as compared to the capital market, and due to lower risk, this kind of lower return is possible due to the investors. So, an investor who is aiming at earning lower profits but maintaining the liquidity of their fund by investing into the money market, they can very easily have multiple kind of options for the investment in the money market. Now, next basis on the basis of which we can categorize the money market is the liquidity. So, the next feature is liquidity. Here, whatever funds you will invest into the different financial instrument, the liquidity of the funds will be ensured. That means your investment will be easily convertible into cash. That means the liquidity of the investment is higher. Whenever you will be in need of cash, immediately, or you can say within 1 or 2 working days, you can very easily convert your financial instrument into cash and you can use it for your different needs. Next is market regulation. So, market regulation, if we talk about, RBI, the central banking agency of our country, makes regulation for the purpose of managing the different kind of aspects related with the money market of our country. So, these are the various features of the money market. We can very easily remember all these features, as well as we can differentiate it with the security market also. The maturity period is less than 1 year. Instruments that are traded, treasury bill, commercial papers, then call money market, certificates of deposits. Participants are banks, corporation, public sector unit, mutual fund organization and RBI. Risk factor is low. Return is also low due to the lower risk element involved. Liquidity is higher, easily convertible into the cash, and market regulations are made by RBI. So, these are the various key features of the financial instruments that are traded into the money market. Now, let us talk about the next thing, that is the various types of financial instruments that are available for the investment in the money market. So, these are the various financial investment options where you can invest your money as an individual investor. The first one is the treasury bills. Treasury bills are basically issued by the RBI on behalf of the government of India. So, we know that the Indian government basically collects the revenue by the taxation system. By collecting the taxes from the citizens of the nation, they arrange the public revenue, and they have some other sources of revenue also, but the public expenditure may be higher as compared to the total of the public revenue that the government may generate. So, sometimes they may not have sufficient funds to finance the various expenditures of the government, such as the infrastructural development or many other areas where they want to invest further. So, in such cases, they can take the money in the form of debt from the citizens of the nation and from other sources as well. So, if they take the money from the citizens of the nation, they can take the help of the treasury bills. So, these treasury bills are basically issued for a maturity time period of 91 days, 182 days or 364 days, that is less than 1 year period. It is basically sold at a discount to the citizens of the nation, and it is redeemed at a face value. That means for investment into the treasury bills of the government of India, you will not be going to earn any interest, but directly you will be not going to have interest, but when it will be redeemed at the face value, the difference between the discounted and the face value will be your profit for investing in such kind of investment avenues. The main purpose of the government to issue the treasury bills is to meet short-term liquidity need of the government, to meet the day-to-day and regular expenditures of the government. The risk level is extremely low as it is issued by the RBI on behalf of the government of India. The risk element involved into the investment into the treasury bills are very low. The various examples, if we talk about how the return will be earned in case of the treasury bills. So, suppose that if at discount any treasury bills is issued for 97,000 rupees, then when it will be redeemed, you will get a amount of 1 lakh rupees on maturity. So, the difference between the 1 lakh and 97,000, that is the 3,000 rupees, will be your return on the treasury bills. So, directly you are not going to earn any specific percentage of interest on the treasury bills, but certainly when it will be issued at discount and redeemed at the face value, the difference will be your part of profit. Now, let us take the next financial instrument, which is the commercial papers. Commercial papers are basically issued by the corporates and the financial institutions, those who are having good credit ratings. These are issued for a total time period of 7 days to less than 1 year for the purpose of meeting the short term funds requirement of the corporation and the financial institution too. These are raised for the purpose of working capital and using it for the short term purposes of the firm. Usually the denominations for the commercial papers are 5 lakh or more. This is tradable in securities market as well, that is the secondary market of the segment, as well as the risk level involved here will be moderate, because it always depends on the credit rating of the corporation or the financial institutions, those who are raising such kind of commercial papers into the market. So companies' credibility is an important criteria for assessing the risk involved into the investment as well as the profitability also. If we talk about the profitability, it is higher than the treasury bills, as they carry slightly more risk as compared to the treasury bills. So with the help of the commercial papers, the companies, the corporates can raise financial funds for them, as well as the financial intermediaries for their different kind of short-term needs can also use commercial papers, and they can raise the short-term funds from the market. Now let us take the next financial instrument, which is the certificate of deposit. Certificates of deposits are basically issued by the commercial banks and some other financial institutions. The time period for maturity in case of the certificate of deposits also ranges from 7 days to the 1 year time period. The nature is that it is a time deposit as well as it is negotiable in nature also. Here you can get a fixed amount of return on the basis of some fixed interest rate, which will be always higher than the saving accounts interest rate that you get from the banking companies for depositing your idle cash into the bank account. The liquidity in case of the certificates of deposits are very much high, because it is tradable in the secondary market before the maturity also. So if you need the cash back from these investments, you can sell it into the secondary market and you can take your investment back from the certificates of deposit. Basically, in case of the certificates of deposits, the financial institution as well as the banking company, they try to manage their liquidity as well as attract more deposits from the investors from the market. So certificates of deposits are basically used by the commercial bank and the financial institution. Now the next one is the repurchase agreement, which are also known as the repos and reverse repos. So basically, in such case of the financial instrument, the main participants in the market are banks and RBI. Basically, these banks and RBI, they issue such kind of financial instrument in the market for the purpose of preparing various kinds of control measures with the help of implementing the monetary policy into the economy. So it is a basically tool for short-term borrowings by the RBI and the banks to manage the monetary policy control in the economy. So banks sell the government securities to RBI with an arrangement to buy back those particular repos from the RBI, whereas reverse repos are the instrument where the RBI borrows money from the banks and lends government securities to them. So in such case of the financial instrument, both the RBI and the commercial banks, the various types of banks that come under the realm of the RBI, they fulfill their short-term financial needs by issuing these securities and taking the funds from the RBI or the commercial bank, as the case may be, for fulfilling their short-term needs. The maturity period in case of the repurchase agreements are often overnight or a few days also. So within a 1 day or within a night also, the maturity period of such kind of instruments may be there, and for the time period for which it is issued, the interest can be earned by RBI or the commercial bank. If we talk about the use, it is basically used for the liquidity management, especially by the central banks, that is the RBI or the major commercial banks, those who are working into the nation. So for the purpose of managing the circulation of money supply as well as fulfilling the various economic needs of the country, whenever the RBI faces any kind of financial crisis, or you can say whenever they face a problem of liquidity, they can take the help of repurchase agreement. Now the next financial instrument in case of the money market is call money and notice money. This is a very short term borrowing that is taken by one bank from the another bank, and the time period for maturity is very less, as it may be from 2 days to the 14 days time period also. Basically, such kind of the financial instruments are issued in the market for the purpose of meeting their reserve requirement. So basically, whenever a banking company is facing difficulty in maintaining the minimum cash reserve ratio of their total deposits, they can take the help of call money or notice money financial instrument. They can raise the finance from the short term, that is the money market, and they can manage their reserve requirements very easily. So they can manage their daily cash needs as well as the reserve requirement that they need to deposit to the RBI. So basically, RBI announces the CRR every year that needs to be maintained by every banking organization for meeting their daily withdrawal needs from the various depositor. So in case if any banking company is facing such issues that they do not have sufficient fund for maintaining the sufficient CRR, they can take the help of the call money market. These are highly liquid in nature and sensitive to the monetary policies of the government also, because the percentage that the CRR will be maintained by the RBI, accordingly the need of the call money and notice money financial instrument will be there. Interest rate fluctuates on the basis of liquidity in the market. So this is the call money or the notice money. Now the next one is the banker's acceptance. So these are issued by the business, but these are guaranteed by the bank. So these type of financial instruments are used by the corporates for fulfilling their short term needs to ensure the various payments that are required to be made to different trade transactions. So in such cases also, the maturity may be typically from 30 days to 180 days. These may be used on an international trade basis also, like a post dated check may be drawn to the business partners, but that will be backed by the banking companies. So these are also tradable in the secondary market at a discount. So this will also help in maintaining the liquidity for an investor. So these are the various types of financial instruments that are traded into the money market for fulfilling the short-term financial needs of the corporates, banks, government organizations and different other parties. Now let us discuss the procedure, how we can invest into the money market. What is the procedure that we must follow for the purpose of investing into the money market? So this is a kind of market where a very low amount of risk is involved, as well as a short term strategy. If you have made, if you have short term financial objectives to fulfill, then you can very easily invest into the money market and you can have good returns also. So the process that you need to follow in case of the money market investment is, first of all, you need to choose your mode of investment. That means how you will be going to invest into the money market. So there are various types of online investment platforms that are available that you can use for investing into the money market, such as Zerodha, Grow and Paytm Money. All these different types of apps can be used for investment into the money market. You can also take the help of brokers or dealers who are registered with SEBI. So these brokers and dealers will trade on behalf of you and invest into the money market for fulfilling your financial objectives. Then there may be various mutual fund organizations also. These money market mutual fund organization helps you to invest into the different SIPs and mutual funds investment schemes. So this can be also taken, as well as banks may also help you in investment of certain specific kind of the financial instruments, such as FDs and certificates of deposit. So these different methods can be used for investing into the money market, online investment platform, brokers, mutual fund organization or bank. Now next step is to open a bank account and open a demat account for the trading purposes. So you need to open these different accounts for the purpose of investing into the money market. For the basic transactions, you must have a bank account with you. Demat account is required for investing into the various financial instruments such as the treasury bills or commercial papers that are issued by the different parties. And trading account is not always required, but it can be useful for specific categories of investment. So these different kind of accounts are needed to be opened by the investor to invest into the money market. Now next you need to select the financial instruments in which you want to invest. So according to your financial objective, different kind of financial instruments are available, and from those you can very easily select in which you want to invest. So if you want to invest into the treasury bills, you can buy it from RBI or retail direct portal or through the brokers registered with the NSE and BSE. If you want to invest into the commercial papers, these are available through the institutional brokers and the mutual funds. If you want to invest into the certificates of deposit, these are issued by bank. You can approach your bank for investing into such kind of investment avenues. Then money market mutual fund, you can use the various apps like Grow, Zerodha, Paytm Market or any other app from where you can very easily invest into these instruments. Then call money repos are there. These are generally accessible to the institutional investors. So these are basically not for the individuals. One bank can issue these kinds of securities to the another. So repos and call money market financial instruments are specifically for banking organizations such as RBI and the other commercial banks. So here only institutional investors can invest. Then you need to evaluate the following factors also before investing. So next step is very important. Before investing into the money market, you need to evaluate whether your investment will be profitable for you or not. So on these basis you can evaluate your financial investment avenues such as tenure. So most of the money market instruments are basically for 7 days to 1 year time period. So if your investment objectives time period is exactly the same, you want to invest your money for less than 1 year, then only you need to invest here. Then if you want to ensure liquidity of funds and you do not want to lock your fund into any investment, then this is the best market for you. You also need to understand that risk is low as compared to the other segments of the market, but usually the returns will also be lower as compared to the capital market. So returns will be 4 to 7% per annum, as well as tax implication must also be analyzed before investing into the money market. So tax implication, if we talk about, these returns that you earn from the money market are taxable, but your income slab will also be taken into account for the purpose of assessing your total tax liability with the help of all these earnings of your daily life. So these factors must be evaluated before investing into the money market. Now the next is to monitor your investment. So you need to monitor various types of financial trends after investing into the money market instrument, so as to keep your investments safe. So you need to keep an eye on interest rate trends. What are the different type of interest rates fluctuations are there in the economy, maturity dates of the different types of financial instrument, and credit rating of the issuers must also be observed and analyzed by you to understand the risk as well as the profitability associated with your financial investment. So this is the method that you need to follow in case of the investment into the money market. Now let us take a real world scenario. If you take a real world example, if any person is going to invest into the money market, then how they can invest. Suppose that if you are an individual investor with a sum of ₹1 lakh and you also need the safety and liquidity of money, but you need a regular return, stable return, then in such cases you can consider the money market mutual fund for investment. since it is a low risky, liquid as well as easy to access investment avenue. The purpose of investment in such cases may be it may offer you better returns than the saving bank account. It is required to be invested your money only for a short term period in case of the money market mutual fund, and the risk is also less as compared to the other financial instrument. So this will help you to fulfill your short term goals as well as it will give you stable return for short term period. So the various steps to invest into the money market mutual fund may be, you need to first, suppose that you have chosen a Grow app for investing into the fund, then you will type money market fund in the search bar. You will select the HDFC money market fund. Suppose that if you want to invest into this, you can select this particular plan, then direct plan, then growth, and after that the next step will be evaluation of the fund. So details and criteria must be matched, such as fund type must be matched, that it is a money market mutual fund only, returns are 6.8% per annum, risk is low, minimum investment required is 500 rupees, and it can be withdrawable within 1 or 2 working days also. So it will help you to maintain liquidity of fund also. After that you will click on the invest now option and enter the amount of investment, and finally the method of payment will be chosen, such as net banking or UPI can be taken, and you will confirm the transaction, and finally the units will be allocated to you based on the net asset value of the money market mutual fund. So this is the real world scenario. Accordingly you should invest into the money market mutual fund. After that you also need to track record of the returns that you are earning into the investment. So after 1 year, that is the maximum year investment time period, you need to assess where the net asset value is grown as per the return guaranteed by the fund or not. So you will earn here 6,800 rupees safely by having lower amount of risk as well as maintaining the higher liquidity of your fund. Okay. Some alternative investment plans can also be taken, such as you can also invest into the treasury bills. So suppose that if you want to invest your fund only for 91 days, treasury bills or can be taken as an option. This can be invested by RBI Retail Direct method. So you will go on the website of the rbiretaildirect.org.in. You will choose to invest in a 91-day treasury bills investment. Suppose that 97,500 will be done. On maturity after 91 days you will get rupees 1 lakh return from the market, and your total return will be 2,500 deducting the 97,500 rupees of investment from the sales value, that is the 1 lakh rupees. So alternative methods may also be there for the investment into the money market. Now let us understand the last topic of this discussion. So in the previous discussion we had discussed about the capital market, where we arranged long-term finance, and in this lecture we discussed about the money market, from where we arrange the short-term financial resources for our different kind of needs. So the money market and capital market together can become very important for the economy, as it helps in the various types of functions, such as the mobilization of savings of the investor, efficient allocation of resources, liquidity creation, price discovery, capital formation, risk management, and it also helps in facilitating the economic growth, and it helps in the policy implementation. So if we talk about the various significance or role of both the capital market and money market, that is the in total, if we talk about the significance of financial market in the economy, it works as a link between the investor and the savers of the money. So it helps in mobilization of saving from individual investor to the economic investors. Then it helps in the efficient allocation of resources. So allocation of fund to the business organizations are done according to the highest potentials of return, and the savers can very easily invest their money into the various investment avenues. It also help in maintaining the liquidity. Easily you can buy or sell your investment into the secondary market. So also it encourages the more participation from the different kind of investors. It helps into the price discovery of the financial instrument as well, because the market helps to determine the fair prices of securities depending on the demand and supply of security into the market. Then it helps in the capital formation by investing the money of the small investor into the economic activity. It helps in the industrial growth and job creation, and it also accelerates the economic activities in the nation, and hence it also contributes into the capital formation. It also helps in risk management. So multiple kind of financial instruments are there, such as derivative instruments are there, that helps you in managing the risk that is involved into the financial transaction due to the time element, due to the fluctuation of the prices of the commodities, and the various other economic risks that may be associated with the financial instrument. So risks such as currency fluctuation or interest rate changes or availability of a particular kind of commodity into the market, all these different types of risk can be hedged with the help of the derivative market. So overall we can manage risk also, and we can aim at earning higher return also with the help of the financial market. In all, by facilitating all these function, it also facilitates the economic growth of the country, as it stimulates the overall economic development of the nation. And finally, central banks is also enabled with the help of the financial market to implement the monetary policies into the nation. So to summarize, we can say that the different kinds of roles that are played by the financial market are: it mobilizes the savings of the savers into the investment, it allocates the resources into various types of economic activities, it provides liquidity of fund to both the investor as well as the corporates, it facilitates the price discovery of the financial instrument, encourages the capital formation, risk management is also done with the help of financial market, supports the overall growth of the economy, and finally it aids in the policy transmission of the RBI and the government of India. So by mobilizing saving, it increases investment, by allocating resources it promotes efficiency, it reduces investor risk by providing liquidity, facilitates the economic health. That means by facilitating price discovery, it promotes the economic health of the nation, it funds the business in expansion, modification by ensuring the capital formation in the nation, it reduces uncertainties involved into the investment by managing the risk of the investor, and finally it helps in creating jobs and boosting the gross domestic product of the nation, and enhances the effectiveness of the monetary policy for the country. So these are the various benefits, or you can say the significance of financial market that is played by the capital market and both security market for the country. With this, I would like to conclude today's lecture. Thank you.